Today is the day that Washington were due to run out of cash, and a deal has been approved by the House of Representatives just in time to raise the US debt ceiling by at least $2.1 trillion. I'm joined by Daniel Morris, a market strategist at JP Morgan. Hi Dan, so a compromise has been made, but the Republicans would have ideally liked more cuts and the Democrats would have preferred less. What's your view? What side of the fence do you sit on?
Well, I think that, as always, given that it's democracy and you've got two parties with different views, that inevitably you're going to have a compromise. And I don't know how much it's worthwhile to decide, what it should have been. I mean, from an economic point of view, you could have had, say, kind of an ideal mix of revenue cuts, revenue increases and budget cuts to say, okay, well, this is going to give you the kind of the optimal growth. And even if you could come up with that, to some degree, I think it's irrelevant because you're dealing with politicians and interest groups and so on, so you kind of accept whatever comes out of the process. So I think the important thing to look at is not so much necessarily what the balance is, but kind of what the dollar figure is. Well, that's right. Well, so if S&P initially had set a target of, say, $4 trillion that they thought they needed to see when they were considering whether or not they wanted to downgrade the debt of the U.S., and that was a number that had been talked about a couple of weeks ago. It was also kind of roughly the number that came out of the commission that Obama had set up a while ago. So if that's the benchmark of where ultimately the country needs to get, I think we need to evaluate this plan relative to that, and it basically gets them about halfway there.
The deal raises the debt limit through the end of 2012 rather than a few months as most Republicans would have wanted. How do you see the situation developing in the short term? Will there still be enough to solve the current problems?
Well, I think a lot of it, in terms of the turmoil and the stress over them actually lifting or not lifting the debt ceiling, will pass pretty quickly. And I think a month or so from now, it will all seem to kind of been a tempest in a teapot. There's going to certainly be an ongoing debate now through the elections, and I think a very positive and healthy one about, how does the country meet these budget goals in terms of the $4 trillion in cuts. And so I think that's just going to be kind of an ongoing current theme. Don't expect necessarily that much more kind of market impact until we get the decision from the rating agencies whether or not they're really going to downgrade or not.
The threat of a credit rating downgrade hasn't been priced in the markets yet. Why is this? What's happening there?
Well, I don't know if I'd say the threat has been priced in. I don't know if the impact, even if it does happen, is necessarily going to be all that substantial. I mean, if you look at other examples, and there aren't a lot, of where you've had developed countries downgraded from AAA to AA, we found 8 when we looked post-war. And if you look at what happened to spreads after the country was downgraded, in some cases the spreads went up, and in some cases the spreads went down. And I think what's really determining long-term government yields, not only the U.S., but the U.K. and Germany for that matter, is primarily economic growth. And it's really the expectations have fallen pretty substantially, even just over the last 2 days or last week, with the GDP numbers out of the U.S. and out of the U.K. and the ISM manufacturing numbers. So expectations for growth are falling. So that explains most of the fall in yields. In theory, you would have a slight increase if there was a downgrade, but I don't think really you're going to see it, because even when the initial negative outlook was put out by S&P, you essentially saw no change whatsoever in yields at the time.
Let's discuss the US dollar. What do you see happening?
Sure. I think up to now, the dollar's been weaker, and ergo the euro seemingly stronger because you've had quantitative easing on the U.S., so that kept the dollar relatively weak. So then the most recent factor would have been the threat of the downgrade in the long-term debt, which again would have made the dollar a little bit weaker. So now that at least the immediate threat of not passing the debt ceiling is gone, that suggests that the dollar is a little bit stronger, because I think kind of the concerns about U.S. debt will fade a bit, especially relative to Europe, because we know we're going to have problems in terms of the Eurozone sovereign debt crisis. I mean, it's even yesterday you saw what happened in Italy. So this is going to be kind of a constant factor. And now that you don't have QE weighing down the dollar anymore, I think you actually are going to see stronger dollar versus the euro. What
about the Japanese yen then? With the US economy in trouble, the yen has been getting a lot of attention recently. Can you talk me through this?
Sure. I mean, it's finally broken through about 80, which is kind of what it's wanted to do since the tsunami and the earthquake, and you had some intervention from the Bank of Japan. But always when you have the central bank interventions, it's only marginally effective. I mean, if there's a lot of market forces pushing a currency in a particular direction, a central bank can only do so much. So they've tried to keep it a little bit weaker. You had Toyota complain about kind of yen strength hurting their own results, but they also raised their guidance for the year. So, the fact that you have of deflation in the country offsets a lot of the currency gain, because the yen strengthening means that exports are more expensive, but you have domestic deflation, so input costs are falling. So it's not necessarily as bad as it appears. So I don't think it's necessarily going to strengthen much now that it's broken through 80. I think it's probably going to more or less stay around this range, say call it 77 to 83 or so, as the bank tries to keep it from getting too strong, but kind of the ongoing forces that we've seen up to now are going to kind of keep it within that range.
Thank you for that, Dan. There will be lots more exclusive interviews here on Dukascopy this week, so stay tuned so that you can stay on top of all the latest financial news. Goodbye for now.